Welcome everyone, and thank you for joining me today. I'm excited to introduce our presentation on unlocking institutional trading logic for precise buy entries within a professional smart money concept framework. Today, we'll explore how to leverage high-accuracy smart money trading setups, focusing on bullish order block strategies. Over the next few slides, we'll dive into the core principles, techniques, and practical insights to help you enhance your trading approach. Let's get started. Now, let's take a closer look at this crucial zone where price often revisits. This is a key area because it allows the market to fulfill any remaining institutional orders, making it a high-probability entry point for traders. Essentially, this zone acts as a support level, where the price is expected to find a strong base due to unfilled buy orders still sitting there. We call this a demand zone, and it's usually where large financial institutions have likely initiated their buying positions. This footprint of institutional activity is important because it often leads to a powerful surge in buying activity, which we interpret as market conviction. When we see this kind of surge, it's a clear sign that the buying momentum is strong and likely to continue. Now, before a significant upward move, there's often a particular candle we pay attention to, the last bearish candle. This candle usually shows a brief rejection or hesitation before the market shifts gears and moves higher. Understanding what a bullish order block is helps us recognize these key zones. It's essentially a cluster of buy orders that institutions place at a specific price level, and these zones often mark the beginning of strong bullish momentum. Recognizing these areas can give us a significant edge in timing our entries and understanding market movements. Let's take a closer look at what bullish order blocks really represent. These are critical zones where institutional buy orders haven't been filled yet. Think of them as the key areas where big players are waiting to enter the market. Once enough liquidity has been gathered in these zones, the price tends to expand powerfully upwards, which confirms the institutional intent to buy. This expansion isn't random. It's a deliberate move by the institutions. Interestingly, this process involves what we call manufactured selling. By creating sell pressure, institutions effectively gather the liquidity they need for large-scale buying. Now, how do they do this? They strategically induce sell pressure, pushing retail traders to exit their positions. This weakens the market from the retail side, making it easier for institutions to step in with their larger buy orders. And it's not just about creating sell pressure. The banks and institutions also quietly accumulate vast buy positions. They do this discreetly, often behind the scenes, so as not to disturb the market prices and alert other traders. All of this ties back to the core institutional logic behind bullish order blocks. It's a calculated process of collecting liquidity, inducing sell pressure, and then expanding the price to fulfill their strategic buying ambitions. Understanding this helps us see the bigger picture of how institutional trading shapes market movements. Let's start with the critical point. No break of structure means there's no valid trade setup. It's essential to wait for that clear break because it signals a shift in market momentum. Now, once you've identified that structure break, look for a powerful, large bullish candle that follows the order block. This candle confirms strong buying intent and adds confidence to your setup. Next, pay attention to the impulsiveness of the candle. A strong, impulsive candle often indicates aggressive buying and can be a sign that the move is likely to continue. Also, ensure that retail sell stops, which are liquidity below recent lows, have been swept. When these stops are taken out, it provides the fuel needed for a significant upward move. That's what we call sell-side liquidity taken. Another critical aspect is a clear break above a previous swing high. This break signals the continuation of the bullish momentum and helps you identify that the trend is still favoring buyers. It's a definitive sign that the market is moving in your desired direction. Equally important is confirming a bullish bias on higher timeframes. When the overall trend on those timeframes is up, it aligns your trades with the dominant market direction, increasing your probability of success. Finally, always remember that to maximize your chances of a successful trade, you should only trade bullish order blocks under specific market conditions. These conditions ensure that your setup isn't just a coincidence, but part of a high-probability scenario. Keeping these principles in mind helps you stay disciplined and aligned with the overall market structure. Let's start by defining the order block. To do this, draw a zone from the open of the last bearish candle to its lowest wick. This area represents where buying opportunities might occur after a bearish move. It's important because it shows where institutional traders are likely entering the market. Next, pinpoint the final bearish candle before the strong impulsive move that broke the previous market structure. Identifying this candle helps us understand where the last significant selling pressure was, setting the stage for potential bullish reversals. Then, observe when the price breaks above the most recent swing high. This break of structure confirms a shift in market dynamics, indicating that buyers are gaining control and the trend may be turning bullish. After that, look for the price to sweep below equal lows or a significant support level. This liquidity sweep is crucial because it collects the sell-side liquidity, often leading to a strong move higher once the liquidity is taken. Finally, always start your analysis by examining the higher timeframes. Confirm that there's an overarching bullish bias before diving into the smaller timeframes. This bigger picture helps ensure your trading aligns with the broader market trend, increasing the probability of success. Let's talk about a crucial aspect of our trading approach: avoiding blind entries. It's vital that we never jump into a trade just because the price looks like it's moving in our favor. Instead, we always wait for specific signals that confirm our setup is valid. One such signal is observing a significant rejection wick. When you see a strong rejection wick, it indicates there's strong buying pressure at the order block, or OB, which is a key level we're watching. Now, to strengthen this signal, we should check a lower time frame for a market structure shift. If we see a bullish market structure shift within the OB zone on a lower time frame, it confirms that the trend is turning bullish, adding more confidence to our setup. Next, we look for a strong bullish candlestick pattern, like an engulfing or pin bar, forming within the OB. These patterns are powerful confirmation tools because they show clear buying interest at that level. After identifying these signs, we wait for the price to retrace back into the OB zone. This retracement offers a better entry point, ensuring we're trading with the trend and at a more favorable price. Finally, to achieve precise entries, we look for confluence, meaning multiple signals lining up, and clear confirmation before executing a trade. This refined setup helps us avoid impulsive decisions and increases our chances of success, aligning perfectly with our overall goal of disciplined, well-validated trading. Remember, institutional trades are crafted to endure market noise, not rely on hope. It's crucial to limit your risk on each trade to no more than 1 to 2% of your total trading capital. This helps protect your account from large swings and keeps your trading sustainable. When managing risk, aim for a tight stop loss, or SL, because it keeps your downside protected. But it's equally important not to make it so tight that normal market fluctuations trigger it prematurely. Make sure your SL is set below the lowest point of the order block's wick. That's where you get maximum protection. By placing your stop loss strategically below the entire bullish order block, you give the price room to breathe, avoiding unnecessary exits. Remember, proper stop loss placement is key to managing risk effectively and maintaining a balanced, disciplined approach. When it comes to risk-reward ratios, ideally, you want to aim for 1 to 3 or even higher. This means your potential reward should be at least 3 times your risk, which is optimal for profitability and managing risk effectively. Of course, a minimum of 1 to 2 is acceptable, but the higher the ratio, the better your risk management. Now, a key concept here is the recommended risk-reward ratio, and I suggest focusing on unfilled fair value gaps above the current price. These gaps often act as magnets for price movement, meaning the market tends to move toward these unfilled gaps. Recognizing these can give you an edge in setting your targets. Speaking of targets, one common area to look at is at multiple swing highs that are at similar price levels. These are often good targets because they represent points where the price has previously reacted strongly, giving you a high probability exit point. You should also pay attention to areas where significant buy-side liquidity, such as retail buy stops, is likely to reside. These zones are crucial because they can trigger price movements when liquidity is triggered, leading to potential reversals or breakouts. Another important target is the previous swing high, which is the last significant peak in the price. This is often an area where sellers previously took control, making it a logical level to consider for profit-taking. Finally, identifying high-probability take-profit targets is essential for locking in gains. These are points where the market has shown a tendency to reverse or pause, giving you confidence that your trade is reaching a profitable conclusion. Connecting all these points, understanding where the market is likely to move, and where liquidity and previous highs can significantly improve your trading strategy and overall success. Remember, true accuracy in trading comes from patience and discipline. It's essential to avoid neglecting proper stop-loss placement and position sizing, because doing so can lead to significant losses that are hard to recover from. Without good risk management, even the best setups can turn into big setbacks. Trying to trade every possible order block on the chart might seem like a good idea, but it often results in confusion and poor decision-making. Overlapping multiple order blocks can clutter your view and make it harder to identify the best opportunities. Instead, focus on high-quality setups and be selective. Another common mistake is entering trades just because the price touched a key order block without waiting for a clear bullish signal. Patience to wait for confirmation is crucial. Jumping in prematurely can be costly. Always look for signs like liquidity sweeps or other indicators that show institutional interest before committing. It's also vital to understand where retail money is positioned and to interpret liquidity flows. Never trade a bullish order block in a bearish market or against the higher timeframe bias. Going against the overall trend increases the risk and decreases your chances of success. In summary, avoiding these pitfalls, such as poor risk management, overtrading, rushing entries, and ignoring the broader market context, will help you improve your accuracy and protect your capital. Staying disciplined and patient is key to consistent trading success. All right, let's walk through the bullish order block trading checklist to ensure we're trading like smart money. First off, your goal is to trade with the big players, not like retail traders, for consistent profitability. That means you need to be disciplined and follow the setup rules carefully. Before you even think about entering a trade, make sure all the critical conditions are met. This helps you identify high-probability setups and avoid unnecessary losses. Now, one of the key points is confirming your entry. I look for clear confirmation signals that indicate a move is likely to continue in my favor. Next, I want to see that a valid bullish order block has been identified. This is essentially an area where institutions have accumulated positions, and it serves as a strong support zone. Recognizing this gives you confidence that the move is backed by smart money. Then we look for a break of structure, or BOS. This means the price has broken previous resistance levels, signaling potential strength and a shift in market momentum. Along with this, I check if liquidity has been swept, meaning recent stops or orders have been taken out, often a sign that institutional players are driving the move. Finally, on the higher time frame, I want to see a bullish bias confirmed. This confirms that the overall trend supports my bullish setup, increasing the probability of success. Remember, controlling your risk with proper SL and TP levels is crucial. Always ensure the risk is managed before entering. When all these conditions align, confirmation, order block, BOS, liquidity sweep, and a bullish higher timeframe bias, you've got a high probability setup. Keep these points in mind, and you'll be trading with the smart money, not against it, leading to more consistent profits.